to this webinar. I'm very glad to see you here, very excited about that. It's maybe not the most sexiest topic or most exciting topic in the field or in the world of trading, but I do think it's a very vital aspect of trading. And more on that, of course, in the upcoming slides. But I welcome you sincerely and glad that you're here. So welcome once again to this special webinar. And before we start this risk disclosure statement, please take your time to take a look and read through that. As you are well aware, there's high risk involved in Forex trading, of course. Please see this as advice and not tradable information. It's just a method to learn, and everything should be fine. Okay? So please take the time for that. Thank you for your attention. All right. So, well, as we know, Admiral Markets, of course, is sponsoring, right? We're with them here. And I would just like to mention that they have a great contest going on with great prizes. So if you want to, join on that, please take a look at forexball.com. I will be also participating, so we can take a very nice comparison with our accounts. And if you screw up that account, no problems, right? It's just a demo, so that makes it a bit fun. Trading and making it fun is also very important, right? So here's some other cool features they have, right? Most of you know that, but just in case that you're new, you can buy and sell directly from the NT4, for example. You have market depth, and great spreads. Okay, so thanks for that. So let's focus on today's goal of the webinar. So what are we going to be doing the next 60 or 58 some minutes? Well, today's goal is how can we actually incorporate time or time factor, all right? In last time, I was more looking like why is time factor important. I'll just make a summary and recap on that at the beginning. But today I want to make it a bit more practical. How can you really use time factor in your trading instead of the philosophical side, like why is it important? Okay, so really basically 3 points will be discussed today. When is a trade entered, or should it be entered? Let me say it this way: when should the trade develop, and when maybe should the trade be exited? That's all what it boils down to. That's what we look at in price. So it makes sense that we should look at the same elements when viewing the time side of it, right? So very simple concept, and I think that doesn't need any more explanations. If you have any questions, please don't hesitate to ask. Let me open up that question box in the meantime, just quickly to see if there's anything in that regard. Okay, yeah, that's good. Does everyone see and hear me? That's always a good thing to check before we really start the show on the road. If someone could write a Y with that confirmation, that would be really cool. Yes, cool. Thanks, Andre. I sometimes forget to check, but that's very important, of course. Cool. So anyone who has questions, please don't hesitate to let me know. Okay. Okay. Well, I actually have a few questions for you, if you don't mind. If you're busy, no problem. If you're multitasking and your hands are occupied by typing, no problem at all. But if you do have time, I would love to get some feedback regarding these questions. That would be cool. We can maybe have some discussion on that. I think the first 3 questions, most people are going to say, a lot of traders are going to say yes, especially if you're new to trading. If you have more experience, then the nervousness is probably going to be a lot less. But even then, you might still have it. Or have you noticed, for example, that when you just entered, the market actually dies down at that moment? More important maybe questions, in my opinion, is the fact, do you have time factor element in your training plan at the moment? Is it something that's really incorporated in your physical trading plan? Do you have a trading plan on paper, or do you have one mentally in mind? Do you incorporate time factor in that? If so, how? What elements might you add? Or if not, do you think it's important, and why not? Why don't you have it? Okay. You can hear me, but you can't see me. No one can see the PowerPoint. I think it should be visible. I hope that the PowerPoint is visible. I mean, I look at the audience view and I can see my own PowerPoint, so I hope that that's all clear. Okay, good. Thank you, Faraz. You can see me. Okay, George is saying thanks for that confirmation. Cool. George is saying no time factor, probably TFE in my plan. Time factor. E will be E. Okay, doesn't matter. Time factor in my plan. Cool. So I'll take a look at those answers. If you have time, let me know, and I'll take a quick review a few minutes from now to see what you all have written. Okay. In the meantime, I don't want to keep the session too long waiting, but I will review your answers in a while. Okay. So just a recap before we dive into how to incorporate time factor in our trading plan. Just a recap. Why is it important? Okay. Now, for most of you out there who are listening to me, you're viewing trading as a business, and you're actually trying to create an edge, create some profits by buying and selling relatively fast. You're not owning a currency and 10 years down the road you exchange it. So that's why time factor is important, because owning a currency in effect is not a risky business. It might be if you receive, for example, an income in dollars and you're here in the Eurozone, your income is going to vary, right? But if you're in the country where you have that currency, not much risk is going on except inflation. Even if you have dollars in Europe, in the EU country, for example, then still it's not, you have those dollars, you physically own them, and nothing, that value is not going to be lost. Now, if you're, of course, trading, we know we have leverage, so we are taking a high risk on a small stop loss position, and that's why it's a risky business. Not the ownership, but the leverage, right? Clear. So a good price, although if you own the currency, might be perfect. If you own the currency, you have no fear, and if it goes from 135 to 130 before it goes up to 150, that's fine. But if you're using it as a business and you're using the leverage, of course, a good price is not good enough. Stop losses and timing are in that regard vital. Timing is vital. Entering at the right price is basically half the story. Entering at the right time is just as important. And in my understanding, or what I've noticed so far, many traders only focus on the first half, not price. And if I would give a percentage, it almost seems, I don't know, 90% is focused on price, and a small bit of information, a small part of the trader community is actually talking or focused on time. Okay? While I believe it's so important. Now, why is it important? It's because the timing is important because it reduces the psychological stress of a trade. Okay, you have improved trading psychology if you enter at the moment that the trade gets moves impulsively away from your entry point and is impulsively, reacting well. If you are stuck in a huge sideways move, it's going to make you nervous. It's going to make you doubt, and this will have a very, very negative effect. It will create impatience by you and a lack of discipline to follow your training plan. Okay, so the psychology is important. Second of all, if you time it correctly, you can optimize your trading with moving your stop loss to break even, taking profits faster. If you're in and out quicker, you have more opportunities. You can maybe take advantage of. So you're overall increasing your effectiveness in and your leverage of your capital. You can employ it, you can invest it actually more effectively. That's what I want to say. Okay? Higher capital mobility and usage. Okay? Third thing is actually that the success rate of your trade decreases if the trade takes too long before it goes your way. Okay? That's another aspect. And the fourth thing, basically very simple observation, is that the chart we look at is a price-time relationship. And we only kind of look at price. And although it's a two-dimensional world we treat it as a one-dimensional object. And that's something I do find fun in a way. Okay? Okay, George is saying time factor element, that's TFE. Cool, thanks for that. Let's see. Jan is saying most profits in Asia. Okay, cool. Okay, so we got some feedback there. So let's take a look at the example. Now, of course, this is very simple process. I can show you something that always fits, and it's more difficult to do it live. But just to get the flavor of what I'm trying to say, for those of you who might have some doubts, you can see that these entries in themselves are, there's nothing wrong with these entries, these black circles here, right? If you're not leveraging it, eventually, quite quickly actually, within a few days, those trades are going your way. But you can see that in some cases you either have huge pip retraces to live through, or long sideways moves, or combination, sideways and pip retracements. So price, is not the only factor, as we can clearly see. I just want to point that out to you. If you take this price right here, I think there was like 133. It's a great trade, right? It's not. It went up to 137, but this not only retracement in pip size, but you can see the time factor is something that's very important, right? Just by looking at the chart. Now, if you own a currency, it's not a big issue, but if you're a leverage market, it's very, very important. Okay. I got a question from AB. Thanks for that. You've marked L entries. Oh well, that was just indeed a theoretical example of if you would have entered, if a trader would have entered in the red circles. I'm not saying that a person should do that, but I'm just giving a theoretical example of why timing is important. Because if you mistime it, then it's a disadvantage. While actually these black circles, the price, everything's okay with the price, right? Because we know that the price is all the way at 137, right up in this corner, going up and up and up. Price is okay if you took it at 133, 134, but when is in fact most important. Okay. Frank, thanks. I will mention the questions next time, okay, so that everyone is clear on that. Thanks for that. Frank was asking that he can't see the questions, that's why. Okay, so the first question, when is the trade entered? Okay. Now, just some standard things that should be part of your trading plan, and I think that most of you do have most or all elements, but it is good to review them. Which time frames do you use for analysis? Which time frames do you use for entries? At what moment do you actually enter? Candle close, or is it a price-related entry? At what point is it actually the best time or moment for you to enter the trade? Which session, which day, which week of the month, which month, if you're a big-time position trader, right? And when do you choose to trade? What are your time limits in that? Many of these things, like a time limit, is something that most of us have subconsciously or consciously thought of, right? But sometimes not. I mean, if you just started out, then you're not aware maybe that the Asian session, the euro and the pound, actually, do not move that much in pip size and oscillate maybe 25 pips up and down. So it might not be the best time to take a trending trade, for example. These are things that should be thought of. Okay. So let me take a look at the time frame point of view. Okay. So traders should choose the time frames on which they perform analysis and the ones they actually enter trades. Right. It's a very important aspect, and the trader should not try to deviate from those time frames, because having multiple time frames is a good thing, I think. Some of you might only use one time frame. For me, that's too limited. I'm too curious about other time frames, and I do think that a multiple time frame analysis perspective gives an edge, but it shouldn't be exaggerated, and looking at everything from a minute to a month could therefore seem confusing, right? So you might want to, even the analysis part could be done on a lot of time frames, but you want to be careful with the entry possibilities on the time frames, because that could get wacky if you are entering on a 1 hour and your analysis on the day chart says that you should do something different, and you're actually mixing trade plans, and the outcome could be quite messy. Okay. So multiple time frames is a great perspective, and it's great to be able to zoom in and out, to zoom out to see the bigger forest, or to zoom in to see the trees and get closer to the market action. But you want to keep focus on what you consider for trading, or for that particular trading account. Okay, you don't want to get too confused either. Okay. Regarding which time frame might be the best, well, I think that's one of the questions maybe I would get from someone. It really depends, but I do think that the 1 hour chart, even if you're intraday trading, is a good balance between intraday opportunities and maybe some swing trading once in a while within the week. If you would like to hold a position after you actually close the day of trading. So the 1 hour does offer that possibility. The 4 hour, of course, is more of a swing trading, but if you use a 50-minute, which is a very low time frame in most cases, then the 1 hour guidance or even 4 hour guidance would be good. All right. I use myself mostly 4 and 1 hour. Okay. For entries. For analysis, I'm looking more at 4 hour and day charts. All right, just to get a clue of what I do. Let's see. All right, candle close. I want to quickly talk about that. All right. Let me see if there's any questions in the meantime. Utam is asking if you can get the recording. I'm not sure if this is going to be recorded, so we'll have to stay tuned on that. I think yes, but I'm not 100% sure, okay? Okay, cool. So first of all, there's nothing wrong, and now I'm going to focus on the next one, right? This candle close, okay? There's nothing wrong with a entry purely focused on a certain price level necessarily, right? If you use a Fibonacci, for example, there's nothing that you can do regarding the time frame unless you wait for confirmation of a strong bullish candle, for example. That might be the right time to enter. But if you're using, for example, a break of the top, or a break of like a candle close above the top, those things then become important. Then in that case, traders sometimes make a vital mistake. For those of you who are waiting, for example, for a candle close above the top or low, waiting for the candle to actually close is, in that case, very vital. Many a trader is actually tempted by the bullishness of a candle, and they jump in early before the actual candle closes. Okay. Now, this is in a way time factor messing with your trade psychology. Here are some reasons why traders might be tempted to make this mistake. Okay, the candle is about to close, right? Maybe we're 2 minutes away from candle close, right? So the trader gets enticed to enter earlier with the argument that they think that the candle will not change much in those 2 minutes, right? That's the psychology. I've had that in the past. Many probably as well, or you will maybe have that one day. So this is wrong. Actually, the last few minutes of a trade, of a candlestick, excuse me, could have a significant outcome of that candle. If you would look at our candle and you would look at the last 5 minutes, you would be surprised how much influence the last 5 minutes of an hour can have on that candle. In most cases, or I would say there's definitely a good probability that it can totally alter. Doji can become a strong bullish candle and the other way around. And that should not be underestimated. I have done research on that, and it's very interesting to see how the identity of a particular candle is well hidden almost in some cases. Not always, right? It's all about probabilities. But it's well hidden to the last part of the candle, and then that character of the candle becomes clear after it closes. So waiting for the close, although it's only 2 minutes, is I think very important, and that's a time factor element that some people get impatient of. Oh, it's anyhow 2 minutes, but it is important in my opinion. Okay. Now, another argument could be the bullishness of a movement has or seems to have a lot of momentum in it. Now, again, this philosophy is not good because in this case, the trader is in fact using a lower time frame and is showing a lack of kind of discipline to wait for the setup in your trading plan. Okay, you need to wait for that candle close before it's useful for your analysis or for your entry strategy. Okay, the bullishness at that moment doesn't mean anything before it's closed. That's similar to the change of the candle between the last minutes. But for example, if you see a 1 hour candle that's usually impulsive and it just started 15 minutes, you might be tempted to think, I jump in now because I get a better price, anticipating a continuation in that direction. The character of that candle can significantly change once again, and this is actually, you're using a smaller time frame than what your originally plan was. Okay. The fourth thing I would like to say is that the trader fears, and maybe that the stock will become too large. Also, really, this is mental tricks and psychological, tricking the mind for fear of having a too big stop and maybe missing a trade. You have to realize that this underlying structure of those thoughts is fear. Okay, what you could do to take away that fear is say, if my stop loss is bigger than 80 pips, I don't take that trade anymore. So you kind of put a boundary in your trading plan and say, if that one or two, whatever candles, if the stop loss after it closes is too big, then I'm not taking that trade. And if I don't take it, tough luck. Next opportunity. So you kind of get rid of that fear element. Here's just a screenshot of what I mean. You can see here, for example, this wick, right? And at one point or another, when this candle is a 4-hour candle, when this candle started, when it was a live candle, it looked like this, the blue drawing I have on the side. Now, if you look at that candle and you don't wait for the close, you think it's immensely bullish. You see this up move, you see this up move, you see this up move, and you see continuation. And you can see how dramatically it actually turns around, you get a wick, and you get a negative close. Same here. You see this wick here? You see a move, a retrace, and a move up. So same thing, just to illustrate here my words in actions or on a chart. Okay. Let's see. Here we have a euro dollar 1 hour chart, And let me see. Not sure which part. Okay, I'm not sure. Well, this screenshot is connected to the next one, and we can see that the time factor element. I think what I'm not sure here what my goal was of this particular slide, to be honest. But here we can see. Let's see. Now I know. We can see a very no. Not sure why. Okay, it doesn't matter. But I think my point was that we can see a very extended time factor here, and waiting for a close can help in that regard. Okay. Okay, we got a question here from Daniel and Frank. That's very cool. Thank you. What time frames combinations do you recommend for scalping? Daniel's asking. Well, I've never really scalped, except for the fun of it, and a few months I maybe did it seriously. Otherwise, I never really was that much of a scalper. But I guess, it all depends in that regard. Maybe you can even use a 1-minute chart and a 15-minute as your higher time frame guideline. It is possible. But I do think that in all cases you still want to get a feeling and a direction of the day. So looking at the beginning of the day, what yesterday's day candle was, and what was the 4-hour candle, and then the 1-hour candle, to get an analysis, first analysis is good, I think. Then if you're really looking for trading it, then use the 1 hour as your 1 hour 15 maybe for continuous during the day updates, and then 5-minute entry probably for scalping. But as I said, I'm not an expert in that. Daniel is saying, what time frames combinations do you recommend for scalping? Oh, I just asked that, sorry. Frank is asking, explain candle close. Don't know what it means. Candle close is basically when we have this candle here, we have an opener and a close. And the open, in this case, this is an hour chart, so at the top of the hour, the candle opens at this price, and this wick is the low of the price, and the top is the high of the price in that hour, and the close is an hour later when the price closes. So basically the price action of that hour, and then the next hour starts, and then you have the same setup. The open of that hour and the close of that hour, and then it continues for that hour. And you can look at multiple different time frames. You can look at 4 hour, and then you see the open of that 4 hour period and the close of that 4 hour period. But that's probably not what you meant. Maybe Frank meant candle close. Or if you have a strategy. Okay, Frank is saying this is the first time he is looking at trading or thinking about trading. That's why. So that's what candle close means. That's just the candle is just a information, price action information that shows you what the price did in that hour. Okay. AB is asking, does anybody know which person that makes money on scalping? I think if you're rich, unless you like trading as a hobby, you're not maybe going to be scalping. You're probably just going to take large position trades, because that's probably the most time effective for you, I would say. Because if you have millions of millions, you just take a good position on the euro dollar at what you think is a good level, and you look for a target, which is a lot more time effective than sitting behind a computer hours and hours. But I'm sure you're people who are good enough to scalp and make their pips on that. But I think you do need to have a good method of identifying when a currency is going to make its daily movement and when not. Okay. Moving averages, Jan is asking which moving average crosses do I use for opening position? Well, I like to use two, I would say, most of the time, a bit longer term and a bit shorter term. But it all depends what you see in the market. I myself like to use often of 20 or 18 and maybe a 50 kind of view for the midterm. All right. So basically, let's see. I went a bit too far here. Let me just take a look at my notes. Okay, yeah, good. So we have here different types of methods. These are, things I don't, these Fibonacci time zones I do not use myself, but they are used for a method of using time in your trading. That requires significant investment in backtesting. I've not done that with the Fibonacci time zones. I did notice that Lucas numbers were very interesting. Lucas numbers are basically the same method as Fibonacci, using 0, 1, and 3 as the base, and then adding the numbers. So 1 plus 3 is 4, 4 plus 3 is 7. And the interesting part about that is that I did notice that many impulsive moves during the day, for example, on our charts, are 3-4 hours. Very interesting. And then you get maybe a 4-hour pause, 3-4 hour pause, or even 7-hour pause, or 11 if it's a very long correction. So I always found it very interesting, this relationship between when does a currency actually move impulsive and when does it stop to give a retrace. And a retrace could be in time factor, it could go sideways, basically what I mean, or you can see a significant counter move in pip size. And it's good information to know if you're intraday trading or taking a position trade within the day or even within the week, to know that, for example, if the currency has moved impulsively on an hour candle and has made a 40 pip, 30 pip impulse with a good candle close towards the high or low, close to the extreme. So if you're in the uptrend, the high is, the close is very close to the high, right? Then many times this impulsiveness, the raw impulsiveness where it really moves a lot, is 3-4 hours, max 5, and not more. Now there are always exceptions, but on average it's a very interesting statistics because it will help you identify when it might be a good time to move your trading stop loss to significantly closer to price action than you otherwise would have, or maybe you take profit, or you just exit the whole position in total because you don't want to live through the Asian end of New York sideways chop, for example. So that's a good method to keep in mind. I also view it the other way around with regard to correctiveness elements. Correctiveness elements, sideways moves, normally tend to take not more than 3-4. If it does, then I'm very careful with my trade. If I enter a trade after an impulsive hour candle and it's not moving 3-4 hours, or even, I'm talking about hour, but it could be day as well, day candles, then the statistical odds of that trade developing in my favor are decreasing. I'm not saying it's totally zero chance, but the odds, the statistical probability is decreasing. Okay, the chance that we're going to get a bigger sideways move in time or a bigger retracement in pips is larger. Preferably, I would actually like to see a move within an hour, like an immediate continuation or an hour or two pause. That would be preferable. But many times the third or fourth are the ones that also go. But after that, it's really not as desirable. And it depends on the situation. I don't have a fixed rule that I get out or stay in if it doesn't move within 3-4, but I'm on high alert. And I do sometimes take it off, or I move my protective stop loss to a break-even position aggressively, and et cetera, et cetera. Now, the switch side of that is also that you know that you have more patience with regard to a trade if you realize that 3 or 4 candles it might take before the trade develops. So the worry, the mental stress is less if it doesn't happen within the first hour. Many traders, I think, then maybe click out their trade and actually see it then go their way the next hour. For example, those are things that can happen, and that's the advantage. Okay. Now, let me see if there's anything else I wanted to mention. Well, basically here, gain angles are also a method of timing your entry, right, and exit. They were waiting for, gain is actually waiting for important tops and bottoms to form on a daily, monthly, weekly, and he draws his angles from those changes in trend. And each angle divides time and price into proportionate parts. The 45 degree angle, that's a 1-to-1, is the most important. And the steeper is 2-to-1, and then the less steep is 1-to-2. Okay, that's actually, he's making divisions on the chart regarding price and time. So that's quite cool stuff, and I would definitely encourage to look at that. And I think that's one of the things that many traders do not look at. I think that has definitely quite an interesting value as a supporting element, right? I think it has more value personally than the Fibonacci time zones, but maybe I didn't look at that enough. That's possible. But anyhow, this is just a summary of which time elements can we use for trade entry. Okay, so that's Lucas numbers, Fibonacci time zones, Gann angles, and as I was saying, paper trade and backtest your favorite currency in your favorite time, and really just write down how many impulsive candles you had, how many corrective, how many impulsive, and see, get a feel by backtesting what the average is approximately in time. Okay? For those of you who don't know what Fibonacci time zones are, they use Fibonacci numbers, and then they use a time sequence. So basically, you take it from top to bottom, that's a 1, and then that length, 2 is twice that length, 3 is 3 times that length, 5 is 5 times that length of the original top to bottom. And then at those points, significant market changes or tops and bottoms occur. Let me open my my drawing tool, so maybe I can draw it. That would be a bit easier, actually. Here. What happens is, for example, you have a bottom here and a top here. Price moves like this, right? And you put your time sequence from there to there, and this is 1. That length of time is 1. And then the next one, of course, is this 2, is of course this length times 2, so that's approximately here. So they would expect something major important here. Then 3 is, I guess, or maybe 2 is here, this is 3, and then 5 is here. 5 is basically then, let's see, twice, this 2 is 2 times this distance. 3 times, 5 times that distance. So those are, then would be important spots, but I've never really seen much of a benefit on that, okay? Gann angles, just for those of you, is like this. This is, of course, price, here's time, and this is the 1-to-1 relationship. This is the 2-to-1, the stronger trend. This is 1 to 2. And basically, if price is going in this relationship 1 to 1, it's a sustainable trend. It's price and time are in harmony, are in balance with each other. 2 to 1, is a significant impulse, of course, this one, but it's not sustainable for a very long run. 1 to 2 is very weak in that regard, and it could signal that maybe this is more of a corrective type of move. Okay, so you can use those lines, and they have different degrees, 3 to 1 and 1 to 3, for to see where price bounces off. For example, oh, I have a Gann grid here. Why am I? Oh, sorry, guys. I have a Gann grid here. A lot easier than me drawing. And you can see that. Let me see. I don't know exactly where I hooked it. Maybe I hooked it here and here. It's not visible on this chart. But this is just a theoretical example. But it is interesting, I think, Gann grid, and it gives you a division of time and price in a different perspective. You can see it here, right? This is Andrew's pitchfork, also one method. This is the Fibonacci fan, also a time-related element, not only a fib, right? The fib is just very clear. You put a fib on this swing high, swing low, or that would be not a good example, but if you put one here on this one, and you get a retrace here, right? That's just time-related. This is time and price, because it has a 38, 2, and 50, and 618 coming as a trend line. Okay. Fibonacci time zone, that's what I was talking about. This is 1, this is 2, this is 3, 5, 8. In this case, I found an example that's not too bad. Here you can see important events at those levels. This one not so much, but those others were pretty interesting. Pretty nice timing from this Fibonacci time zone. Okay, so that's about it with the entry. I have to speed up because I see I'm going a bit slower than I should. Okay, we have 18 minutes left. When should the trade develop? A clear time limit supports your trading psychology, and I've actually mixed it up a bit. I already talked about this, I guess, in some regard. But a clear time limit supports your trading psychology. It gives you that element of patience and discipline and ease in the back of your mind that, okay, I still have time. I still have time. I don't necessarily need to expect the trade to go right now, right? It gives you that confidence to give a trade sufficient time and space. But it's also the opposite is true. It also allows you to know when not to give a trade sufficient time and space, right? I already talked about the 4 to 5 candle impulsiveness. But here, as I've put it in bold, please do your own testing on the chart, because that's vital. Because whatever I say, you can incorporate, you can find it useful, but actually you must do your own testing. Seeing is believing. Hearing is just knowing about it. And it's good that you know about it now so that you can see it. But you must see it yourself, right? Okay. By the way, I've done most testing on this on the 1 and 4 hour chart, but I've been doing a bit of work on the day chart as well. I haven't gone necessarily much lower than I haven't looked at 15 or 5, so but who knows? Maybe that would make sense too. I know at the top of my head that the pound dollar at the London Open, because that's the one I did try to scalp for a while. It does like to make 5 impulsive 15-minute candles at one point or another. It does move a period of 1 hour and 15 minutes most of the time in one direction. It's a very interesting statistic. So if you see, for example, that that the currency is moving in an impulsive way with after London Open, then, well, not necessarily after London Open. I have to be careful a bit. That I'm not 100% sure, but it is after. Let's see, should be for sure. I think after European Open. I would have to check again. But there is a period, and please check yourself. There is a period of 75 minutes, 5 50-minute candles, where the currency really has a full thrust most of the time. Okay, so if you know that and you identify that, then you know that on a 5-minute candle you can enter maybe twice till that time limit, and then that's maybe you should be more careful. So that's something I remember doing on the 15-minute level. Otherwise, most of my testing was done on the higher time frames. Yeah, that's Frank is saying scalping is question mark. Yeah, that would be definitely scalping indeed, a 50-minute. But yeah, these correlations on the pound I definitely noticed. So something for you to consider, and if you like that information, you can test it yourself. Right? So regarding the second element, when the trade should develop, I have some charts here to look at to show you what we can expect and what I'm talking about. Okay, regarding those time frames. This is the Aussie 1 hour chart. Sorry, here. Okay, and I have an L if it's more of a lengthier wait than the 4 or 5 hours, and S if it's more or less meets that criteria. Okay, and you can see that we have 4 hours impulse, we have 4 or 5 sideways here, but we don't get a continuation, and that's actually when the trade reverses. We get let's say 1 impulse, 2 sideways, more or less 2 impulse, but that last one reverses, and we get 1 impulse, 4 sideways, more or less 4 impulse here, 1 rejection, 2 impulse, 4 sideways, 4 impulse, 4 sideways, etc., etc. And if it doesn't go within 4 or 5 hours, it gives a bigger one, right? It gives a bigger one here. I forgot the L. This is a smaller one. And in some cases, if you're waiting more than 4 or 5 hours, sometimes if you wait more than 4 or 5 hours, you get this chop. But in other cases, you actually get a bigger reversal. Okay? Let's see what next example I have. This is Euro-dollar 5 minutes. Let me see what the meaning was of this. This is just to show you when the European session opens, or maybe max an hour before that. Not much, because the euro and the pound hardly move during the Asian session, as most of you know. In fact, the pound moves in 89% of the cases from top to bottom during the first half of Asian, first 4 hours, not more than 30 pips. I think, or was that the whole Asian session? I would have to check. But so you can imagine it doesn't move more than 30 pips. 89% of the cases on the pound dollar. So that's also a useful statistic. That was on a year's data, by the way. So you can see, these moves. This is 5-minute chart. I think that looking at the number of bars is 3, 10. This is something like an hour and 50 minutes right here, I think. All right. Let me see if there are any questions now. No. Okay, cool. This is an example on the Euro-dollar 4-hour chart. And, this is just one of those things you can do yourself as well. Impulse 2 hours, impulse 3 hours, impulse engulfing twins right here. Engulfing twin is where price action of one movement totally takes over this price action here. Then we have a new momentum going, 1 impulse, 2 or 3 impulse, 1 or 2 here, 2 sideways, or 3. In this case, it's actually 2. I made a mistake. Continuation. And now we have again a turnaround. You can see that the turnaround happens here with 5. And we have again these numbers that we were already talking about. So you can see that many times the impulse is short and the correction is longer. Okay, but the most interesting is when the correction is actually shorter. So this is something that could be very interesting. For example, if you use this information to see if you can get a entry on the second or third candle, if it is acting indeed as you think it is. If it's not, then maybe you can expect this. And then you can wait for that to finish before you enter. Okay? Oh, that's it? Okay. Well, that's regarding when the trade should develop. Well, in that regard, you can use the Fibonacci time zones, Gann angles, and Lucas numbers as well, right? You can, in that regard, use that for your entries and for your following of the trade. Now, I'm really running out of time, but when is the trade exited is probably actually one of the most important things, so I have to go, fortunately, a bit faster, but we have different types of methods we can use. It is the price-related method, for example, Fibonacci target or extension, right? Those are actually quite in sync with the market because that's where the market naturally tends to gravitate to. If you use a certain pip size, for example, my pip size risk is 40 pips is my stop loss, so therefore I'm going for a 2-to-1. It's an 80 pip target. It could work out well, but you could miss your target by 10 pips too. And it's not so in sync with the market. It's just a random number. Okay, so not so much in sync with the market. The fib targets are better. It's not, unfortunately, this webinar cannot go into the exact details on how you use fib retracements to get the precise targets. That will have to be discussed in a totally separate webinar because that's a totally different matter and subject. If you have interest in that, send an email to Admiral Markets and say you have interest in that, and we'll set that up for you. Okay. But that's just that's a whole webinar on its own. Okay. Then you have static indicators like trend line breaks, for example, and that's a good balance. It's not like perfectly in sync because but it does give some space. It's a good balance, giving space, time, and stuff like that. Okay. Trend lines can also be steep, so they have a time element as well, right? So continuation, you have price and time methods. So we have first price methods, then you have price and time methods. Now price and time methods is, for example, an added wave count. If you expect a third wave to end at a Fibonacci target, so there is some kind of a combination, or a fifth wave, or you're expecting a wave 4 or 2, that is another way of doing it. Of course, many of you know that Elliott wave is not the easiest of things, and it's very debatable and subjective. I do think it's manageable. I do use that actively in my trading, but it does require a lot of practice. So I agree with everyone on that. It's not the easiest of things, for sure. Dynamic indicators could be, and they're more flexible, right? For example, a parabolic is possible. I don't use it myself. I use more moving averages, but Ichimoku is possible, and ADX is quite interesting information, statistics, but and the divergence and convergence, of course. If we have divergence, that might be a good place to take your profit because we can expect some pause or retracement. Mind you that many people try to trade the opposite direction once they get divergence. That's a bit of a trickier skill, and but taking profit is always something that is recommendable, I think. Okay. So this is when is the trade exited, price and time. And of course then we have time-related methodology where we can see that we use our time-focused method with the Lucas numbers or the Gann angles, for example, as a methodology. Okay. Personally, as I said, I like to use ADX and moving averages as a trail stop for part of my position. And the other part, I like to take profits, very hard take profits. So I do that because those take profits are located at fib extension and fib targets numbers, and most of the time that is where the currency tends to give some respect, either in time or in pip size. But there is always a continuation possibility after that, and sometimes I better manage to get in. So that's why I still want to keep a part of it on for maybe a further fib target. So that's why I have a part of it goes for a hard target at a fib number, and part of it is I use for ADX and moving averages and divergence. Okay, that's what I use myself. I have, I guess, otherwise some examples here. Just taking a quick look here, you can see that I'm using the euro dollar of recent price action. This was one of the first moves up on the euro dollar. This is a 4-hour chart. We had a retracement, then a move up, then a retracement, then a move up, and then in fact actually we had this big huge sideways move, and then something like that to the 137 area. All right. This was I think the very first turn of that euro dollar somewhere I think somewhere last year. You can see that if you use this fib retracement, you can see how well these targets work, where the market indeed stalled at those levels. Okay. That's with a wave on top of it. You can see if you would take an entry at the green and you would use fixed ratios, that it doesn't work as optimal. You know, you would maybe catch one of them, but the second will be, just a miss or miles off. So this is examples of exit methodologies, right? MACDs, ADX, parabolics. You can see in some cases works very nice. Trend lines as well. Here you can see a nice trend line. You would have gotten out exactly at the time that the currency was actually not going anywhere after that. And you caught, by putting a trend line under the bottom, you actually caught the most impulsive part. This is an example of a trend line that didn't work too well because actually it broke it, but then continued up. I did it on purpose. The moving average is another method. It's a bit slower than the parabolic. You see here, in this case, the parabolic would have given a better exit. Here too. But sometimes the parabolic is a too early exit, like here. So it's something to think of. But I think a mix of hard profits, take profits, and trading, in any case, does make a sense. And it's up to you which balance you find interesting. Of course, you have to look at what your psychology, what fits your psychology best. But the ADX is also very interesting information here. Well, I guess it's time for the summary, considering the fact that we only have a minute left. I hope that you will gain some insights on how you can use time factor for your trading, and that you realize that by incorporating that in your trading plan, and not only price levels, you will be more patient and act with more discipline during the non-trading hours, right? Before entering the trade, after entering the trade, during the trade, and when exiting the trade. And all of them have time factor as well as price, of course. So I hope you can see that it's really vital in that whole trading process. Okay. That's about it, I guess. This is Admiral Markets in the social media, Twitter, Facebook, and Google circles. If you have any questions, I'm afraid I didn't leave much time for questions. I'm glad there were a few questions in between. so that I could at least answer some of them. Please note that contest, that's always a cool thing to do. And look at these advantages of Admiral Markets. Next week, we'll be having, actually in the next 3 weeks on the same day and time, we will be having webinars with different topics. One of them will be talking about the physics of trading. That's 3 weeks from now. That will be using physics concepts and implementing that in trading. And time is also there, part of it. And gravity. And the next week we'll be talking about moving averages. And I think the week after, a trade plan setup or something like that, or the other way around. So for those of you who found this interesting, maybe you'll find the next one interesting too. But in any case, we'll be talking about a trading plan, trading strategy, moving averages, and physics in trading, the next 3 webinars, okay? So if there's no questions, you have a last attempt if you still have a question. No? Okay, cool. I thank everyone for being here. I hope you enjoyed it. I hope you learned something. I encourage you to paper test and back test, and take this hint of a knowledge, or hopefully you've learned here that something new, and you can use that to implement in your trading plan and develop your trading to a higher level. Okay. If not, then I thank you in any case for listening, right? And thanks for being here. Okay, Daniel. Let me see. I will write down your email. See if it's possible. How do I do that? Okay, guys. Thank you for being here, and I wish you good trading this week, and see you next time. Cheers, guys and girls.